Hello everyone. In this video I'm going to cover part of the statement of cash flows. As you know, the statement of cash flows has three components: the operating activities, investing activities, and finally financing activities. In this chapter or in this lecture video, we will be covering operating activities and how to compute it using one of the available methods. So as you might know by now, that the objective of a statement of cash flows is to provide information about the cash receipts and cash payments. So the inflows of cash, and outflows of cash during an accounting period, of course, as usual. So it's like the income statement from a specific date to another specific date. Unlike the the balance sheet, which has a specific day, one day, which is a snapshot in time. Again, as we said, there are three main activities in the statement of cash flows. So as I mentioned before, the three main components. Let's start with the cash flow from operating activities. And here we're talking about day-to-day operations. For example, when you collect an account receivable from a customer, so what's happening in this case, your account receivables go down and your cash go up. So this is one example. Another example, if you pay an outstanding bill, what's happening in this case is that your accounts payable go down and your cash goes down as well. So this is a cash inflow because your cash went up, and this is a cash outflow because your cash went down. This is a general example. Also, you can say if your inventories go down, so you are making more sale, and thus, for example, you make a sale. So your inventory or inventories go down and your cash go up, and so on. So we have several examples in the operating activities. Cash flow from investing activities, mainly such activities have to do with the expansion of the business or shrinkage of the business. So for example, if this company, if the existing company acquires another company, so an example says acquire another company. Basically, your assets go up, so the whole balance sheet is now bigger, and your cash go down because you're paying the owners of the other company. Another example might be here, sell a land, a piece of, let me call it a parking lot. So what happens is that assets go down and cash goes up. When I'm referring to assets, I don't mean only total assets. I'm referring basically to the parking lot in specific, because you know cash is part of assets. But in general, assets will decline due to selling the parking lot, and then cash will go up when you receive the money of this land. Finally, we have cash flow from financing activities. This has to do with borrowing money from the bank. So borrowing money from the bank or issuing bonds, for example, your liabilities will go up and your cash will go up as well. Another example might be issuing new stocks, which is also part of the financing activities, or new shares. What happens in this case is that your owner's equity goes up and your cash goes up as well. So on the following 3 slides, we'll be reiterating what I mentioned in the previous slide. Under operating activities, this section of the statement of cash flows includes cash effects of those transactions reported in the continuing operations section of the income statement. So here, I need to stress this point. There is a direct relationship between the income statement and the operating cash flows. Okay, so this income statement and operating cash flows, they have a direct relationship, which we will introduce in a minute. Some examples from cash receipts: when you make a sale, when you receive interest and or dividends, other proceeds from operations, payments or outflows of cash when you pay a supplier, pay interest, pay income tax, and other expenditures. Investing activities, it involves plant assets, intangible assets, and investments like mergers and acquisitions. When you acquire another company, they include cash receipts from selling investment and plant and intangible assets, cash proceeds from collecting principal amounts of loans, because here this one might be a bit misleading, but if you think about it, when you collect the principal amount of loan, let's say that you lend someone else or some other company your money. You are investing this money in another company for their interest. So assume that you purchase the bonds of another company. So you have the bond and you give them cash because you took bonds, right? This cash that went to the other company is an investment. You are investing in this company, but you're not investing in their stocks. So it's not an equity investment. You are investing in their liabilities, in their bonds. So it's a debt investment. So this is called an investment, and this is why the proceeds from collecting the principal only, the principal amount of the loans, is considered an investing activity. However, the interest payment, the continuous interest payments, like the semi-annual interest payments we've seen in chapter 10, are considered operating activities. Cash payments under investing activities include payments to acquire investments and plant and tangible assets, and amounts paid to borrowers. Okay, finally, the financing activity, it includes items that result from debt and equity financing transactions. Examples of the cash receipts under financing activities is the short-term and long-term borrowing. So if you issue a note payable for $1,000 that will be paid within 3 months, so this is a short-term borrowing. A long-term borrowing might be getting a loan or issuing bonds. Remember, in the previous slide, I mentioned bonds in a sense that you are buying bonds. So you are lending money. Here you are borrowing money. When you issue bonds, you are borrowing money. Another example, cash receipts from owners, received from owners such as selling or issuing stocks. Repayment of amounts borrowed, excluding interest payments, goes under the cash payment in the financing activities. Again, remember, interest payments is considered an operating activity because it appears in the income statement, right? This is the main distinguish between operating and financing activities. In the operating activities, anything that has to do with the income statement will appear in the operating section. So you know that you have sales minus cost of goods sold, you get gross profit minus other expenses over here, other expenses. So this is gross profit. Then you deduct interest and you deduct taxes to get net income. So interest is part of the income statement, and therefore it's an operating activity when it comes to cash flow. Now, as I mentioned at the beginning of the lecture, we are interested in cash flow from operating activities, how to compute. So this is our main question, how to compute cash flow from operating activities. We have two methods, the direct method and the indirect method. We will focus on the indirect method. Okay, just for your knowledge, the direct method provides reader with the nature and dollar amount of specific positive cash flows and specific negative cash flows. So this one is more detailed. More detailed. This one is handier or more practical. More practical. So we will focus on the indirect method. We will not discuss the direct method. So the indirect method, as I mentioned before, there is some sort of relationship between the income statement and operating cash flow or cash flow from operations. The point here is that we will start with our ultimate goal is to reach the cash flow from operations, and this is a specific number, of course. We will start with the net income, which we know from the income statement. We will add a few things. We will deduct a few things so that we reach the cash flow from operations or from operating activities. Let's first start with a simple example. Assume that your account receivables, so this is on a side note, if account receivables goes down, it means that you collected cash, so your cash will go up. Again, if your inventories go down, so your cash is expected to go up because you are selling. So we realize here that when current assets decreases, cash will increase, right? Okay, so we established the relationship that says when current assets decrease, cash increase. So this is the first one. Leave it on the side for a minute. Let's move to current liabilities. If your notes payable goes up, it means that you borrowed money, so your cash goes up as well. Therefore, your current liabilities move in the same direction as cash. So when current liabilities go up, your cash also goes up. And the opposite is true. If you think about it, if your notes payable go down or your accounts payable go down, it means that you are offsetting some of your outstanding bills or debt, and therefore your cash will decrease. So when current liabilities go down, cash also go down. The same applies for current assets. If your inventories go up, it means that you are purchasing more inventory, right? And therefore, if you think about it, when your current assets go up, your cash will go down. So if current assets go up, your cash will go down. Think about inventories. When you have more inventory in your warehouse, it means that you paid for more stock or inventory, and therefore your cash goes down. Therefore, in which of those cases your cash is increasing? It's when current assets go down, which is this one, and your current liabilities go up. In both cases, cash is increasing. So you will add any to net income. You will add any decrease in current assets and any increase in current liabilities. At the same time, what causes a reduction in your cash balance? When your current assets go up, which is this one, and when your current liabilities go down, which is this one. So you will deduct any increase in current assets and any decrease in current liabilities. Okay? So it's a very simple concept. All you need to do is to start with one of them, and the easiest one is a reduction in account receivable or in current assets. When your account receivables go down, it means that you are collecting more money, so it's more money, it's an addition to the net income, and this is due to a reduction in current assets. The rest can be figured out by logic. So if current assets go down, it's an addition to net income. Therefore, when current assets go up, it's a reduction from net income. And the opposite is true. When liabilities go up, it's an addition to net income. And when current liabilities go down, it's a reduction to net income. When you do those adjustments to net income, you will reach the figure that we are after, which is cash flow from operating activities. So this is basically summarizing what I said. You have current assets, CA, current liabilities. When current assets increase, you will subtract from net income. When current assets decrease, you will add to net income. As for the current liabilities, it's the opposite. So when current liabilities increase, you add to net income. When current liabilities decrease, you subtract from net income. Okay? So net income plus you add to it. So this is net income, the starting point. You add to it any decrease in current assets and any increase in current liabilities. So add to net income, decrease in current assets and increase in current liabilities. You deduct the opposite, increase in current assets, decrease in current liabilities. You will reach cash flow from operating activities. Okay? So basically, this is a more detailed recipe, if you want, for the indirect method of how to compute operating cash flows. So net income, add to it depreciation expense, then add any decrease in current assets, any increase in current liabilities, and add back non-operating losses deducted in computing net income. Here we have two new items. The first one is the depreciation expense. Remember that in the net income or the income statement, you deduct depreciation expense. However, depreciation expense is a non-cash component. It has nothing to do with cash. So when you use your vehicle, for example, your depreciation expense goes up and your net income goes down, but your cash is unaffected. Therefore, you need to add it back to net income so that you can reach operating cash flow. So this is why we add back depreciation expense. Non-operating losses should be added back to the net income, and non-operating gains should be deducted from the net income, because those non-operating losses and gains do not affect cash. And that's why we add losses back and deduct gains. As for the decreases in current assets, so this is the reduction in current assets and increase in current liabilities. The opposite applies here. Any increase in current assets should be deducted, and any increase in decrease in current liabilities should be deducted, and the non-operating gains will be deducted, non-operating losses will be added. The only one that doesn't appear in both sections, the add and deduct, is the depreciation expense, which we always add back to net income. Eventually, your statement of cash flows will appear like this. So cash flow from operations starts with net income, add some items, deduct some items, and you will get cash flow from operations. Then you will be given items that will appear in the investing activities, which we did not cover in this chapter, and then some items that will appear in the financing activities. Eventually, you will see that the change from the beginning of the period to the end of the period, which is 1 year in this case, which is a $5,000 over here, is detailed in those three sections: operating, investing, and financing. 3 sections.